Elon Musk has suggested that as the head of the Department of Governmental Efficiency, he's going to support and possibly even pursue eliminating the CFPB, the Consumer Financial Protection Bureau. So in this week's Mortgage Matters, a weekly video where we talk about rates and what's happening in the mortgage market, we're going to dive deeper into the Consumer Financial Protection Bureau and what its potential elimination could mean for mortgage rates and also for housing moving into 2025. So this all started with a tweet that I'll show you guys that was in response to a comment around this de-risking, debanking controversy. And so debanking is the practice where financial institutions terminate or restrict services to certain customers or groups without clear justification. The argument is that they have done risk analysis and they are afraid they're going to take financial losses if they don't restrict certain services to certain groups. In May 2024, Elizabeth Warren and Representative Ilhan Omar addressed concerns about de-risking, saying that it could be used to disproportionately affect marginalized communities, specifically Muslim Americans and immigrants, and they urged financial regulators to combat this. So the CFPB, it would be their role to combat this and step in and be a intermediary or someone who may restrict the financial institution's ability to de-risk. And so the controversy surrounding debanking basically involves balancing financial institutions' risk management with the need to provide equitable services to all Americans. So this whole controversy goes on, and you have a tweet about it, and Elon Musk's comment here on November 27th, 2024, delete CFPB. There are too many duplicative regulatory agencies. Now, de-risking, debanking, as far as housing goes and mortgages goes, couldn't really care less about it, aren't concerned about it. We issue mortgages to anyone who raises their hand and says they want one, and anyone who meets the minimum guidelines set in place by the government-sponsored enterprises, Fannie Mae and Freddie Mac, as well as VA and FHA. So I'm not really concerned at all with the debanking argument, but when you have a comment like delete the CFPB, there are too many duplicative regulatory agencies, that's a potentially statement and action that has broad sweeping complications or broad sweeping implications for the mortgage market. So just how would that play out and exactly what does it mean? This story obviously got picked up by a lot of different publications because it has broad sweeping implications for a lot of different parts of the government. But when we specifically talk about mortgages and what CFPB does with regards to mortgages, when it was implemented as part of Dodd-Frank legislation in 2011, it did a couple big things. So the first thing that it did is it merged the Truth in Lending Act with the Real Estate Settlement Procedures Act, and this created the loan estimate and the closing disclosure. So one of the things that potentially could go away if CFPB goes away is some of the TRID, TILA RESPA integrated disclosure requirements. The argument is that it unified a couple different documents and made it easier for borrowers to understand the loan terms they were receiving. You can argue that it's a more complicated document than the HUD-1 form that was previously used, or the ALTA settlement statement previously used to disclose loan facts and figures. Personally, I think those documents, the older version of the document is simpler to read, but the loan estimate closing disclosure that replaced those documents, there's some benefits to them. It's easier to see what the interest rate is. It's easier to see what the APR is at a glance. It's easier to read those documents fast. So if you have CFPB goes away, potentially those loan estimate closing disclosure documents go away. And with them, a lot of specific timing requirements, like the loan estimate has to be given within 3 days of certain information being received from the borrower, like their birth date, loan amount, property address, and some other stuff. The closing disclosure has to be sent out to the borrower with no further changes, no later than 3 days prior to closing. So there's been a lot of issues where a loan term has to change and now closing has to be delayed because you have to redisclose the loan and wait. So potentially, if you eliminated CFPB, you would eliminate the LECD, loan estimate closing disclosure requirements, which means two things. Loans could potentially close and be originated much quicker, and the industry could be a lot more nimble in adapting to last minute changes. It also would remove a lot of financial, or not financial, but auditory and compliance oversight requirements, because there's just a lot less dates to track and a lot less information to track. So potentially could drive down the cost of origination and speed up mortgage origination. Another thing CFPB was responsible for was the ATR and QM standards. So ATR, ability to repay, and QM, qualified mortgage. And what these rules did essentially is it required lenders to validate or verify ability to repay, to validate and verify income, essentially. And most lenders were already doing this, but it certainly created more of a framework and definition about what income can count and what income can, and how income has to be documented. And then a qualified mortgage put restrictions on the cost that a borrower can incur in getting a mortgage. So while it does protect financial institutions from issuing higher risk loans, that's true, it also massively reduces borrowers' options in the lending environment. Some borrowers really would like the opportunity or option to take on a loan that had a higher cost of origination if it meant substantially less long-term interest over the life of the loan. And right now, those borrowers can be restricted from that. It also took a lot of loans off the table for people who may not have the standard definition of income that the ability to repay rule requires. So people that have a very creative income, maybe from cryptocurrencies or from foreign trusts, or all kinds of unusual income that falls outside of the traditional W-2, 1099 self-employed income, those borrowers have a really hard time getting approved for mortgages. So potentially getting rid of CFPB could improve access to mortgages for borrowers without traditional income. There was some mortgage servicing rules that CFPB put in place that basically established protections for borrowers, including a prohibited dual tracking, simultaneous foreclosure and loan mod efforts. So if a borrower fell behind in payments, previously a bank would pursue foreclosure while also pursuing loan modification to help the borrower keep the home. And so you had instances where a borrower was trying to loan mod and trying to get caught up, and all of a sudden foreclosure occurred. So some of these mortgage servicing rules, I do think, were good rules that were put in place, and those are practices that should probably stick around. And specifically for that item, it required a bank to say, look, if we're going to allow you to explore a loan mod, we have to freeze our foreclosure process until you've had an opportunity to fully explore that and determine if that's going to be the right option for you. And then one other thing that they did was the Home Mortgage Disclosure Act, or HMDA, reporting enhancements. And this is basically collecting borrower demographics to try and reverse engineer where discrimination might be occurring. Again, I think discrimination, I've never seen any of it in my market. Anyone who walks through the door and wants to borrow money, as long as they meet the guidelines for the loan, we're going to be thrilled and happy to originate a mortgage for that person. But I think on a broader scale, when you look at website design and national advertising spend at a huge scale, you can see some unintentional discrimination potentially. So increasing reporting on borrower demographics, sure. It's great to have, and I don't think that's going to go away or should go away. And then loan originator compensation rules. This basically prohibited certain compensation practices, such as basing a loan officer's pay on loan terms. So loan officers' pay right now can only be based on loan amount, not on loan terms. So loan officer is going to get paid the same whether they issue a 5% mortgage or a 10% mortgage. Doesn't really matter. It's based on loan amount. And The confusion around that did lead to some loan officers taking advantage of the situation and preying on less informed borrowers and eking out higher compensation. However, there is a lot of oversight here, or a lot of, like the tweet mentions, duplication of oversight, where if a lender prior to CFPB's rules regarding loan officer compensation, if a loan officer was being predatory and taking advantage of borrowers for higher compensation, well, that was already prohibited under a lot of other statutes and a lot of other agencies. So if CFPB goes away, who's going to replace them? Right now, I'm going to run through a quick list of the different agencies that regulate mortgage lending. Florida Office of Financial Regulation, Florida Department of Business and Professional Regulation, Florida Attorney General's Office, Florida Housing Finance Corp. Then there's the federal agencies, Department of Housing and Urban Development, Federal Housing Agency, Federal Housing Finance Agency, FHFA, the FTC, the Office of the Comptroller of the Currency, FDIC, U.S. Department of Justice, Securities Exchange Commitment, and U.S. Department of Agriculture and Rural Development. All of these agencies, all 12 of those agencies right now have varying degrees and responsibility of oversight for mortgage lending. So creating CFPB and having CFPB as an additional body of oversight, while it does unify some of this enforcement and regulation, a lot of this already exists and did exist previously prior to CFPB. But CFPB has certainly stepped in and sort of taken the reins and assumed a lot of the policing and reporting responsibility for a lot of violations. They've also massively slowed down and complicated the process of originating a loan for a borrower. So potentially, if we talk about getting rid of CFPB, we may introduce some risk back into the market in terms of there may be some more predatory practices by unscrupulous loan originators that have to be sussed out and dealt with. But we will also massively speed up the time it takes to originate a mortgage, be able to offer a much broader variety of mortgage products to potential buyers and borrowers that don't have access to mortgages right now. And we'll drive down the cost of originating a mortgage, which at a time when mortgages are, by comparison, pretty expensive and home affordability is low, any cost savings we can pass on to a borrower is going to be a big advantage and help more buyers get into homes. So overall, I'm in the camp where I would like to see CFPB go away. But obviously, we don't want necessarily all the changes that were put in place as a result of them to go away. And I don't think that they necessarily would. So we're going to be tracking that, and it's just something that may help with affordability as we move into 2025, 2026. If it's cheaper for buyers to buy houses and it's faster and easier for buyers to buy houses, well, look, that's great for buyers. It's also good for homeowners because it allows prices and homes to continue to appreciate as the cost of ownership starts to decrease. Hopping into just exactly what's going on with mortgages right now. So we can see if we look back here when we were at 7.9% in October of 2023, we've actually made a lot of headway here in the last 13 months, essentially. As we come a little bit closer, we're kind of seeing we're still bouncing around the 7% range. And then if we get a lot more narrow, you can see just in the last, coming back from November 20th, just in the last 10 days, 2 weeks, we've actually made up a lot of ground, coming nearly a full 1/3 of 1% down in rate, which is going to be great for borrowers heading into December, which, a lot of people think maybe the holidays isn't the ideal time to move, but something to think about. A lot of sellers that put their home on the market in March, April, and May, if their house is still sitting out there with 7, 8, 9 months on the market, a lot of borrowers aren't out shopping right now, and a lot of buyers aren't shopping. This could be a good time to go in and make some low offers and get some really good deals on houses. So something to watch there. Where are we going to see the rate in the future? We can see the biggest piece of economic news of the month in terms of mortgage rates is obviously the jobs report. Jobs report came out. It was pretty much right in line as expected. So we're not seeing a big change or a big shift in rates. But what we did see is a big change in the expectation of maybe whether or not the Fed will cut rates in December a little bit further, the SOFR secured overnight funds rate. So, again, that can be paradoxical. Sometimes when the Fed cuts rates, we see mortgage rates drift down. Sometimes when the Fed cuts rates, we see mortgage rates spike if it's seen as inflationary. But right now, we're sort of hovering in that 6.75, 6.85% range, and we've been making good progress. So hopefully we'll see that continue here through the month of December. If you made it to the end, I just want to say thank you for watching. Again, I'm Don Harkins with the Don Harkins Mortgage Team and Don Harkins Realty. We are a full-service brokerage, property management company, and mortgage origination company. So if you have any questions regarding real estate, give me a shout, and be sure to like and subscribe to see more Mortgage Matters videos and other real estate related and housing news and videos and tips as we go through the rest of the year and into 2025. Thanks and have a great week.